Well, hi everyone, I'm Judy, and welcome back to Reflections and Real Talk. This week, we've witnessed a notable downturn in the markets, causing concern among investors. Today, I'm going to delve into what's happening and, more importantly, discuss strategies to maintain composure and focus on long term investment goals.
It's hard to ignore the trending financial headlines while watching your portfolios losing a significant amount of value without panicking.
Over the past week, major indices like the S&P 500 and the Nasdaq have experienced significant declines. The S&P 500 is down almost 5% this year, while the tech-heavy Nasdaq has dropped around 10%. These shifts have understandably made many investors uneasy. Several factors are contributing to this volatility. Recent trade tensions, particularly between the United States and Canada, have unsettled markets. Additionally, persistent inflation concerns and the Federal Reserve's stance on interest rates are influencing investor sentiment. It's quite natural to feel anxious during these times. However, it's crucial to remember that market fluctuations are a normal part of investing.
Market downturns are normal. Since 1907, the stock market has had numerous bear markets. And guess what? Every single time, the market recovered and went on to hit new highs. Here's some perspective. The average bear market lasts about 289 days, or 9.6 months. The average bull market lasts 2.7 years, almost 3 times longer. If you stayed invested after 2008 crash, you could have quadrupled your money by now. So the lesson? Market downturns are temporary. Selling in fear can cost you big time. When the market drops, people tend to make the same mistakes over and over. Let's break them down so you don't fall into these traps. Mistake number 1, selling in panic. You only lose money when you sell at a loss. If you sell after a downturn, you lock in your losses and miss the recovery. Mistake number 2, timing the market. You might think you will buy back in at the bottom, but studies show that even professional investors fail at timing the market consistently. Mistake number 3, ignoring your risk tolerance. If you're losing sleep over your investments, your portfolio might be too aggressive for your risk level. Mistake number 4, not having enough cash reserves. Having an emergency fund means you don't have to sell investments at a loss when you need cash. Just missing the 10 best market days can slash your returns in half. The best days often come right after the worst ones.
Here are just a few strategies to help you navigate these turbulent times. Focus on high-quality investments. Prioritize companies with robust balance sheets and self-sustaining business models. Avoid firms heavily relying on debt or external funding. Diversify your portfolio. Spread your investments across various sectors and asset classes to mitigate risk. Maintain a long-term perspective. Remember, investing is a marathon, not a sprint. And short-term volatility should not derail your long-term plans. Learning from market history, historically markets have experienced downturns but have also demonstrated resilience and the ability to recover over time. Staying informed and patient is key. While market downturns can be unsettling, they can also present opportunities for the disciplined investor. By staying informed, focusing on quality investments, and maintaining a long-term outlook, you can navigate these periods with confidence. And here are some other strategies to protect your investments and thrive during a downturn. We talked about portfolio diversification, but what does this mean exactly? Don't put all your money in one place. A well balanced portfolio includes large cap and small cap stocks, bonds, both corporate and treasuries, dividend stocks for passive income, real estate investments or REITs, and some investors like to add gold and commodities for inflation protection. And don't forget to keep an emergency fund. If you're still working, aim for at least 6 to 12 months of expenses in cash. If you're retired, you might want to keep as much as 2 to 3 years in a mix of cash, money market funds, and short term bonds. Practice dollar cost averaging. If you're not already retired or able to continue to invest in the market, this strategy can work for you. What this means is continuing to invest consistently over time. Instead of trying to time the market, investing consistently, whether the market is up or down over time, this smooths out the highs and lows. In addition to focusing on high quality investments or choosing strong companies with solid balance sheets, you want to rebalance your portfolio annually. This means that if you're invested in, say, for example, a mix of 70% stocks and 30% bonds, if the market drops, your asset allocation may shift. Rebalancing helps keep your risk level in check. Seek guidance from a financial advisor if you're not sure how to manage asset allocation yourself. Keep the bigger picture in mind and develop a long term mindset. Every bear market has one thing in common: it ends. And when the recovery comes, you'll want to be in the market, not on the sidelines. The bottom line: stay invested, stay diversified, and don't let fear drive your decisions. The market rewards patience. So, are you feeling a little calmer about the market downturn? Remember, investing is a long term gain. Stick to your strategy, avoid panic, and trust the process. And here's my disclaimer: the information provided in this video is for educational purposes and should not be considered financial advice. Always consult with a financial advisor before making investment decisions. Thank you for joining me today on Reflections and Real Talk. If you found this discussion helpful, please like, subscribe, hit that notification bell, and share your thoughts in the comments below. Remember, staying calm and informed is the best strategy during market turbulence. Until next time, take care and happy investing.